A trader with a 1:5 risk to reward ratio can lose money consistently for years. And a trader running a 1:1 ratio, the one you were told never to use, can build generational wealth. If that sounds backwards to everything you have been taught about risk to reward, good. Because what you have been taught is incomplete. And that gap in your knowledge is costing you real money. Here's what most retail traders do. They open a chart, find what looks like a setup, and ask one question. What's my risk to reward ratio on this? If it's 1:3 or better, then take it. If it's 1:1 or 1:2, then skip it. They have been told that a 1:3 ratio means they only need to be right 25% of the time to break even. And mathematically, that's true. So they go hunting. They took for 1:4, 1:5, even 1:10 setups. They extend their take profit targets to make the ratio look beautiful on paper. And then they wonder why their account keeps shrinking. The ratio looks perfect in their trading journal. The account tells a completely different story. Here's what's broken. The ratio they are calculating has nothing to do with the market structure. Their take profit is placed at a round number, a random percentage, or whenever the math gives them the ratio they want. Not where the market is actually likely to go, and their stop loss placed tight to keep the ratio high, not where the trade is actually invalidated. So they get stopped out constantly. They catch maybe 20% of the move they were targeting, and the beautiful 1:5 ratio never materializes. Let me give you the real equation, the one that determines whether a trader is profitable long term. Profit is equal to win rate into average win rate, subtracted by loss rate into average loss rate. This is called expectancy. Risk to reward ratio is just one input in a system of 5, not the system itself. Notice what's in the equation. Win rate, average win size, average loss size, all three must be managed together. A high R into R ratio only helps you if your win rate is sustainable at that ratio, and your execution actually captures the full target. Here's a question the ratio obsession never asks. What percentage of your 1:5 targets do you actually reach? For most retail traders, honestly, it's under 30%, which means their real achieved ratio isn't 1:5. It's closer to 1:1:1.5. And suddenly the math doesn't look so beautiful. Profitability isn't a number on your trade plan. It's what happens when 5 variables work together. Win rate, execution, quality, market context, risk control, and trading psychology. Remove any one of them, and the ratio becomes meaningless. Let me show you 3 real trading profiles. Same market, same time frame, very different results. A trader A wins 72% of the time and loses money. Why? Because every loss wipes out 3 wins. High win rate with negative expectancy is the most dangerous trap in retail trading. Trader B has a textbook 1:5 ratio in their plan. Their achieved ratio is 1:1.4 because price never reaches their targets. They're not trading a 1:5 system. They're pretending to trade a 1:5 system. Trader C wins less than half the time. The ratio is boring. 1:2.2. But they set their stops at a structure. Their targets are at realistic resistance levels and they take partial profits. Their expectancy is positive $34 per trade, compounding over hundreds of trades. That's a career. The winner isn't the trader with the best ratio. It's the trader who understands why every number is that formula matters equally. So how do serious traders actually use risk to reward? Here's the framework. And it's nothing like what the courses teach. Notice the stop loss point. Professionals don't place stops to protect the ratio. They place stops to define when they are wrong. If price breaks the level that made the trade valid, they exit. The ratio is consequence of that logic, not a design constraint. And partial profits? This is the move that turns a 1 into 2 setup into a 1 into 3 realized trade. You take 50% off at the first target. Move your stop to break even and let the second half run. Your downside is now 0. Your upside is still open. 3 truths that will reframe everything you know about this topic. Truth 1. Chasing 1 into 10 setup is one of the fastest ways to destroy an account. A 1 into 10 setup requires price to move 10 times your stop distance without reversing. In real markets, especially Forex and crypto, that almost never happens without pulling back to your entry first. You get stopped out. Then the market continues. You watch it from the sideline. The setup wasn't wrong. The target was delusional. Truth 2. A 1 into 1 ratio in the right condition outperforms a 1 into 5 the wrong ones. In a ranging, choppy market, taking 1 into 1 scalps with a 65% win rate is a sound strategy. The expectancy is positive. The drawdowns are manageable. Meanwhile, the trader hunting 1 into 5 setups, in that system markets get stopped out repeatedly because there simply isn't enough momentum to hit those targets. The ratio should be chosen by the market structure, not by your preference. Truth 3. Consistency is the variable that multiplies everything. A positive expectancy of $10 per trade, applied consistently over 1,000 trades, make $10,000. The same $10 expectancy applied inconsistently, skipping trades, revenge trading, moving stops, makes nothing or less than nothing. The ratio is a tool. Discipline is the engine. And context, your understanding of what the market is actually doing is the intelligence that drives both. Most traders will keep hunting perfect ratios. They will journal 1 into 5 setups they never actually hit. They'll tweak entry rules but never their mindset. The ones who become consistently profitable stop chasing numbers. They start understanding markets. They build systems based on expectancy, not aesthetics. If you are serious about becoming profitable, stop chasing ratios and start learning how markets to remove. That's what separates a retail gambler from a professional trader. Subscribe if this channel teaches you things other channels won't. And if you want to go deeper, just comment on this video. Thank you so much.